afternoon. My name is Sheila Lamb, and I'm with the Virginia SBDC Network. For those of you who are not familiar with our organization, the Virginia Small Business Development Center is a partnership program between the U.S. Small Business Administration, George Mason University, and local host institutions throughout Virginia. With 26 locations across the Commonwealth, we provide training and technical assistance to small businesses in their local communities. Our one-on-one advising services are available at no charge. Today's webinar, Federal Taxes and Your New Business, is presented by the Virginia SBDC Network. Please save the date for our next webinar in the IRS series, IRS Workshop Business Use of Your Home, on February 20th. And I'm going to drop that registration into the chat momentarily. We are recording today's presentation, and it will be posted on our website, virginiasbdc.org. Due to the large number of participants, everyone's microphone is muted and the chat feature is turned off. But if you have questions during the presentation, you can type those into the Q&A box and we will address them at the end of the session. We have also enabled the live transcript function, which you can show or hide via your own meeting controls. And now it is my pleasure to introduce our presenter for today's session, Cheryl Jackson. Cheryl is a senior stakeholder liaison for the state of Virginia with the Communication and Liaison Office of the International Revenue Service. As a senior stakeholder liaison, she is responsible for establishing and maintaining stakeholder relationships and for providing education and outreach to the small business community and tax professional organizations. Cheryl started her career with the IRS in 1997 and has served in many capacities, starting in accounts management and moving to collections as a revenue officer. Cheryl believes education is the best way to promote voluntary compliance of the law. Please join me in welcoming our presenter, Cheryl Jackson.
Thank you so much, Sheila. I appreciate you. I'm so happy to be here. Happy New Year. Hopefully this will be a positive report for the entire year, because we're going to be doing these monthly. We're going to go ahead and get started as far as the presentation is concerned. Just letting you all know that as a new business owner, there are so many resources that we have available with the Internal Revenue Service. Our website, irs.gov, has a lot of information that is just out there and just waiting for you to look into our to seek out our information. So first of all, we're going to be providing this lesson is going to be providing a basic summary of what you need to know about successfully operating your business, as well as providing you with some of the resources for additional information. So we're going to get started on that. Now, as far as what we're going to be covering today, what we need to know about successfully operating your business, as well as providing you with some of our resources for additional information. Specifically, I'll explain the purpose of the employer identification number, describe basic record keeping requirements for tax purposes. So this is going to be basic. It's not going to go fully in depth. We have another presentation that we're going to be doing later on in the year with more information attached to it. We're going to define basic bookkeeping and accounting methods and explain the forms of business organizations. And we're going to define a gig economy and suggest how to select the paid tax preparer, because a lot of people look at it as, oh, well, I'm just going to go out there and get started. But sometimes you need assistance. And before you even start your business, one of my best suggestions is going out and coming up with a team to support you, because you may need that team. And before I begin, I want to remind you that you need to also understand your state and local tax reporting requirements, in addition to the federal requirements that I'm going to be describing. So I will be covering just federal Internal Revenue Service ramifications. But if you're going to be looking at operating a business, you also need to do some research into the state, whatever state you're in, but particularly the state of Virginia for today. Now, we're going to get started with the federal employer identification number. Now, an EIN identifies tax returns filed with the file with the Internal Revenue Service, and as a business owner, you may be required to get an EIN. You will need an EIN if you pay wages, have self-employed return self have a self-employed return plan, operate your business as a partnership or a corporation, or if you're required to file any of the tax returns like employment, excise, fiduciary, or alcohol, tobacco, and firearms. Your type of business may not be required to attain an EIN, but you may need an EIN for dealing with other businesses, including banks, and that require an EIN to set up a business account. The IRS will give you an EIN even if you don't need it for tax purposes. The fastest and easiest way to get an EIN is online. You can apply for that EIN on irs.gov/EIN. You can just go to, or you can just go to irs.gov and type in EIN in our search bar at the top of the page. Typically, once you get there, you will get the first, if you type in EIN, the first selection that will come up is employer identification number. The EIN is assigned is the permanent federal employer identification number for your business, and this EIN can be canceled if the name or social may be canceled if the name or social security number of the principal officer does not match the Social Security Administration records, or if your business already has an EIN. So just to let you know that there are possibilities of cancellation if you don't have the right information down for your EIN. Also, now we're going to also address record keeping for your business. As a business owner, you must keep receipts, sales slips, um, invoices, records of account, records of cash receipts and expenditures, bank deposit slips, canceled checks, and other documents to substantiate your items of income, deduction, and credits. Although it may sound like a lot of work, unless you have records showing the source of your receipts, you may not be able to prove that some are non-business or non-taxable. So, say for example, you have a business account, you want to make sure you separate your personal and your business stuff. If you and like you have your income coming in, you don't want to have both of your personal income. Say for example, you have a business on one side and your personal income on the other. You have the business that you own, and then you have income from a wage job. You want to keep those separate so that there's no commingling of funds. You don't want your income, your expenses. You're paying for your business expenses with your business income, and paying with your personal income for your personal, um, paying for your personal expenses with your personal income. Um, Now, recording these items will help you pay only the tax you owe. So you keep that in mind so that your taxes are, um, taxes are as accurate as possible. Now, we're going to look at how in-depth your records need to be and how long you need to keep them. Your records must support the claimed amount, the time and the place, the business purpose, and your business relationship to any other persons involved. If your records are incomplete, they may not support your deductions. You must keep your records if their contents may be material in the administration of any Internal Revenue Service law. Usually, the statute of limitations for an income tax return expires 3 years after the return is due or filed for, or 2 years from the date the tax is paid, whichever is later. To support Um, to support items of income or deduction on your tax return, you must keep records and the statute of limitations for that tax returns until the statute of that statute of limitations for that return expires. So there are special record keeping rules if the records are connected to a property. So there's certain records you have to keep even longer than that particular tax return, depending on what the rules are for certain items. Generally, these records, you keep the records until the period of limitation expires for the year in which you dispose of the property. You must keep these records to figure out any depreciation, amortization, or depletion deduction, and to figure the gain or loss when you sell or otherwise dispose of the property. If you've received property in a non-taxable exchange, your basis in that property is the same as the basis of the property you gave up, increased by any money you paid. And of course, the basis is the cost of the property. You must keep the records on the old property as well as on the new property until the period of limitation expires for the year in which you dispose of the new property. If you have employees, then you must keep tax records too. You must keep all employment tax records for at least 4 years after the date on which the tax return becomes due or the tax is paid, whichever is later. There are some circumstances where records may have to be kept longer. If you charge your method of accounting, records supporting the necessary adjustments may be material for an indefinite time. And as discussed earlier, records that establish the basis for original or replacement property must also be kept longer. If you lost your records due to circumstances beyond your control, such as a flood or an earthquake, you may substantiate a deduction by reasonable reconstruction. So, having to go back and try to recreate those records by pulling things from other sources may help you to be able to substantiate your records in case of a disaster. For more information on record keeping, see publication 583, Starting a Business and Keeping Records. For information about employment tax records, see IRS Publication 15, The Employer's Tax Guide. You can find these publications at www.irs.gov, and you can also go to irs.gov and search using the keyword record keeping, and they have a whole page that is dedicated to record keeping. Now, we also want to look at bookkeeping systems. Now, I'm not here to tell you exactly what to use. I'm telling you that you have to use something. Many people who operate their own one-person business never bother to set up a business bookkeeping system. Their personal checking account serves as both personal and a business account. The IRS, however, recommends that you open a separate business bank account. There are two types of business bookkeeping systems: single entry and double entry. The single entry system is the simplest to keep. With the single entry system, you record a daily and a monthly summary of business income and a monthly summary of business expenses. The system focuses on the business's profit and loss statement and not on its balance sheet. While single entry is not a complete account, it shows income and expenses in enough detail for tax purposes. The double entry system is more complicated. It has built-in checks and balances. It is self-balancing and is more accurate than the single entry system. Because all businesses consist of an exchange of one thing for another, whether it's a service or whether it's a product, double entry booking is used to show the twofold effect. Now, we also have the accounting methods. Once you've selected your bookkeeping system, um, you also need to select an accounting method. Your accounting method is a list of rules that you use to decide when and how you report your income and expenses. The two most commonly used accounting methods are the cash method and the accrual method. On your record, you must use the same accounting method you use to keep your records. Under the cash method, you report all income in the year you receive it. You usually deduct expenses only in the tax year in which you pay them. Under the accrual method, you report income in the year you earn it, regardless of when you receive the payment. You deduct expenses in the year you incur them, whether or not you pay them that year. Now, businesses that have inventory for sale to customers must generally use an accrual method for sales and purchases. However, many small businesses with gross receipts averaging less than $10 million a year may use a cash method for sales and purchases. For more information on the differences between the cash and the accrual method of accounting, see IRS Publication 538, Accounting Periods and Methods. There are computer software packages that are very useful as well. They're relatively easy to use and require very little knowledge of bookkeeping and accounting. You have to be careful. If you use software, you must be able to produce records from the system to support what is on your tax return. And always keep a backup copy in a safe place. Again, we don't necessarily suggest a specific type of accounting software, but we do tell you should use something. There's a lot of things out there. So, all right, now we're going to test your knowledge. Up to this point, we've covered quite a lot of information, and it's time to test your knowledge. So we're going to look at this example with Sandy. Sandy is a business owner, and you decide whether she is using the correct accounting method. Sandy has a website where she sells custom ordered and handmade knitted goods, hats, scarves, and books and socks. Excuse me. Customers order online, but because it could take a few weeks or even a few months to get the supplies and finish the order, she doesn't charge them until the product ships. She uses the accrual method of accounting. She records the sale in the month when she ships the product, not the month that the person actually orders it. Is Sandy correct in using the accrual method? And you can type your answer into the chat box. And Sheila or April or Jenny.
Yes, Cheryl.
Um,
Actually, we
I
have the
can't
chat
see it.
box turned off, so
Okay.
just
Okay,
as a
well that's
reminder,
fine.
just because we have so many attendees on,
Okay,
just to keep
that's
things
awesome.
neat.
What we can
Um,
do is I want you to take note of your answer, and I'm getting ready to give you the answer.
Great. Yeah, so
I have
if
no
everyone
problem
could
with
just
that.
answer in their head, that would be great. We did have
That is
a couple
awesome.
answer in the Q&A, but sorry about that.
Yeah, no problem. I didn't even that didn't even hit
Okay,
me.
no
So we're
worries.
gonna move forward.
That's great. All right.
Like I said, have your answer in your head. Um, we're at the answer, and the answer is yes. Yes, it is. Sandy can use the accrual method of accounting. This method can be used because there can be some length of time between when a customer places an order and when it ships. Sandy records revenue when the customer is charged. That is when she ships the order. So we got Sandy covered. Now we're going to talk about business structures. So we're going to talk about business structures. Early in the life of your small business, you'll need to decide on the structure of your ownership. There are 5 common types of business organizations: sole proprietorship, partnership, corporation, S corporation, and limited liability company. Now we're going to look at the advantages and disadvantages of each. And of course, you can go on our website for more information. We have a small business and self employed tax center at www.irs.gov/small business. And you would click on the link to business structures, and under the information section, they have each item listed, and you can click on that link. And for each type, like if you want to look at sole proprietorship, and it'll give you all the information on a sole proprietorship, including the filing requirements and things like that for those forms. So that's just a little plug for the IRS website. Now, we're going to talk about the sole proprietorship. A sole proprietorship is an unincorporated business that one person owns. Advantages of the sole proprietorship are: it is the simplest type of business organization. The sole owner of the business has complete control of the decisions. You don't have to ask anyone else anything. It's all yours, your baby. Um, the sole owner is, again, as far as any decisions or changes that you make, you don't have to ask anyone about that. But with advantage, there are also disadvantages of a sole proprietorship. The business does not exist apart from the owner, and it is the owner who assumes that the risks of the business to the extent all of his or her assets, even if the owner does not use his or her personal assets in the business, um, can be held liable. One of the things that I take notice of is when I was working in collections. One of the things that I learned pretty quickly is that if you have a sole proprietor, say for example, someone owns a small business as a sole proprietor, they don't have a tax ID number, everything falls on them. They file their return, they would have a Schedule C and all of that. But if they owe taxes, even if they have a tax ID number, because in some cases people have they will have a tax ID number if you have employees, even as a sole proprietor. Well, you go in and you don't file your tax return, or you don't pay the taxes for your employees. Well, with a business, there is the issue with the trust fund assessment, where that, and we'll get into that a little bit more later. But with a sole proprietor, the as collection, um, you didn't have to do a trust fund to um, attach the individual's information. All their information, everything that they have, is attached to that business. So if they didn't pay their taxes, it was like, okay, well, we just go after their personal stuff. So a person is surprised when they've gone in and owe taxes under the business side, and then we levy on their personal wages. They're thinking, oh, that's separate. That's my personal wages. No, when you're a sole proprietor, everything comes under you. That's you. And essentially, it is you. So just to add that on. Um, Additionally, the ability to finance the business, known as capital, is limited to whatever the owner can come up with, including loans from financial institutions of which the owner is personally responsible. A sole proprietor files his or her taxes using the Schedule C, net profit from a business. On the Schedule C, that's what that form is called. The Schedule C is included with the Form 1040 to report the profit or loss from the operating business, and the sole proprietor also files the Schedule SE for self employment tax to report the Social Security and Medicare taxes on net profits of the current year's threshold. If you or your spouse jointly own and operate an unincorporated business in a non community property state and share in the profit and losses, you are partners in a partnership and not a sole proprietorship. So you should not use a Schedule C, but there are exceptions to this rule. For example, if you and your spouse wholly own and operate an unincorporated business as community property under the community property laws of a state, you can treat the business either as a sole proprietorship or a partnership. There's another exception for qualified joint ventures for spouses. If you and your spouse each materially participate as the only members of a partially owned and operated business, and you file a joint income tax return for the tax year, you can make a joint election to be treated as a qualified joint venture instead of a partnership. This allows you to avoid the complexity of Partnership Form 1065, U.S. Return and Partnership Income, but it still gives each spouse credit for Social Security earnings on which retirement benefits are based. And you can see publication 334, which is the tax guide for small businesses for individuals with using the Schedule C. So it gets a little bit more complicated when you and your spouse are trying to operate this business without going in and getting incorporated and things like that. So that's just a little bit of extra information that we provide. But while we're talking about partnerships, we're going to move on to partnerships. Um, That is the second type of business organization we're going to talk about. It is a relationship between two or more persons who come together to carry on a trade or business. Each person contributes money, property, labor, or skills, and each expects to share both the profits or the losses of the business. Any number of persons may join in a partnership. The advantages of a partnership are that it is easy to organize, it has a definite legal status, and it may have a greater financial strength than a sole proprietorship because now you got everybody that's in this partnership. Their basically their credit is involved in that business. So, as far as getting financial backing or whatever, the first disadvantage of the of is this is that decision authority is divided. Okay, so with a partnership, um, that liability of the partners is usually limited unless otherwise stated in the partnership agreement. That is, each partner may be held liable for all the debts of the business. For example, if one partner does not um, exercise good judgment, that partner could cause not only the loss of the partnership's assets, but also the loss of the other partner's personal assets. So when you get into a partnership, whatever business you get into, you have to be very careful about who you do business with because you never know. They if that person comes in with all this razzle dazzle and then all of a sudden they make decisions that you don't agree with, you're held liable for the mistakes that they make. So you could be personally liable, meaning your personal assets, your home, your cars, whatever, could be held liable based on your that other partner's decisions. And that comes into play whether you in certain cases with like I said, I talked about that trust fund earlier. With the partnership, everybody is liable, just like with a sole proprietorship. When you're dealing with a general partnership, the general partners are liable for everything. Like I said, just like the in the in the sole proprietorship. It's just that what if they're broke, they don't have any money and you do, and they're making all these decisions, and then all of a sudden they're going to come for both of you, not just the one making the bad decisions. So, and I mean that with when I say they, I'm not just talking about the IRS, I'm talking about other um areas as well that your business may um owe money to. So partnerships report their profit or losses on the Form 1065 U.S. Return of Partnership Income. The Form 1065 summarizes the business activity of the partnership, and a partnership does not pay tax on income from daily operations, and that the income and all the income, losses, deductions, and credits generated by the partnership processed through to the partners. Each partner gets a Form 1065 Schedule K1, the partner's share of income, deductions, credits, etc. And the partners report these items on their personal income tax returns. Partners must still file employment tax returns and pay employment taxes on employees' compensation. If you want to know more about partnerships, you can see IRS Publication 521 Partnerships, as well as the instructions to the Form 1065 and 1040, where more information is available. Now, we're going to get to corporations. Corporations are treated by law as legal entities. That is, the corporation has a life separate from the owners and has rights and duties of its own. So the corporation is its own entity. The owners of a corporation are known as stockholders or shareholders, and it may be worth noting one person can be the sole shareholder of a corporation. So, managers of a corporation may or may not be shareholders. Forming a corporation involves the transfer of money or property or both by the prospective shareholders in exchange for capital stock in the corporation. For purposes of federal income tax, corporations include associations, joint stock companies, and trusts, as well as partnerships that operate as associations or corporations. Now we're going to cover the advantages and disadvantages of a corporation. Um, The advantages of a corporation are that the stockholders have limited liability for corporate debts or actions. The transfer of ownership is easy. The stock can be sold, and raising capital and expanding the business may be easier. Now, the disadvantages are that this corporation is subject to tax on its income at the corporate level. And when the income is distributed as dividends, that income is taxed again at the stakeholder level. Owners of a corporation who work in the business are typically considered employees, are paid a salary, and both the corporation and the employee pay employment taxes on that salary. It is wise to consult an accountant and an attorney specializing in corporate law, as corporations may be more difficult and expensive to organize than other business structures. Additionally, the corporate charter filed with the Secretary of the State restricts the type of business activities and is subject to many state and federal controls. So you would file the Form 1120 for U.S. corporate tax return, and you can also look at the publication 542 for corporations for more information. And just like I said, I would definitely talk to a tax preparer before I started the idea of going with a corporation. Not to say that it's not a good idea, but you want that backup to know what you're doing, how you're doing it, and because setting up your status can be lay the foundation for your business to be okay versus not okay ultimately. Now, the next one we're going to talk about is the S corporation. An S corporation is a small business corporation whose shareholders elect to report corporate profit or losses in the same manner as that of a partnership. Like partnerships, S corporations do not pay taxes. Unlike S corporations, C corporations are taxed at the corporate level. Then, when the income is distributed as dividends, it is taxed again at the shareholder level. Organizing shareholders of a corporation who wish to avoid double taxation can file the Form 2553, Election by a Small Business Corporation. This election must be submitted by the 15th day of the third month of the first S corporation year. So we're going to give an example of that. If your S corporation tax year begins on January 1st, you must submit Form 2553 by March 15th. Otherwise, the election is effective for the next tax year. The IRS will send you a CP 261 notice as acceptance of that S corporation status to let you know they received it and approved your election. You should receive your approval in 60 days. If you do not, you contact the IRS campus where you filed your Form 2553, and you can find more information about that on the actual instructions for the Form 2553. An S corporation does not pay tax on income from daily operations. All income, losses, deductions, and credits generated by an S corporation pass through to the corporate shareholders. The shareholders then report their items on their personal income tax return. However, there are situations where S corporation is subject to an entity or corporate level tax. For example, an S corporation officer shareholders who provide services to their corporation are employees, and their compensation is subject to employment taxes. By law, officers of corporations are employees for employment tax purposes, and their corporation um, is wage, and their compensation is wages. An S corporation must pay reasonable compensation, must pay reasonable compensation or wages to a shareholder employee in return for the services the employee provides the corporation before a non wage distribution may be made to that shareholder employee. In other words, they must be compensated first, then they get the distribution. An S corporation has the combined advantages and disadvantages of partnerships and regular corporations. S corporations file 1120S U.S. income tax return for an S corporation. And the S corporation provides each shareholder a Form 1120S Schedule K1, shareholder's share of income deductions, credits, etc. The shareholder uses the K1 um, to complete Part 2 on Form 1040, Schedule E, Supplemental Income and Loss, as well as any other forms and schedules the shareholder must file with their individual income tax return. And yes, there's two different K1s, the one that says 1120 Schedule K1 and the one that says the 1065 Schedule K1. So um, now we're going to move on to the limited liability company. And I'm going to take a sip of water because I sound rough. And excuse me. All right, so now we're going to get into the limited liability company. The final structure is that limited liability company. It is a legal entity created under state law. It became very popular when it first came out, and there are advantages and disadvantages to that as well. The LLC is separate from its owners, who are referred to as members. An LLC can own property, incurs debts, and enters into contracts. LLCs are popular because owners or members are personally protected against the LLC's debts. They have limited personal liability for the debts and actions of the LLC and without many of the formalities of the corporation. This is an advantage for this type of business organization. Other features of the LLC are more like partnerships, providing management flexibility and the benefit of flow through taxation. For federal income tax purposes, an LLC may be treated as a sole proprietorship, a partnership, or a corporation. Also, for federal tax purposes, owners or members of an LLC can make an election to be treated either as a disregarded entity or a partnership. If you want to know to tell the IRS how you treat your business for federal income tax purposes, you need to file the Form 8832. That is an entity classification election. If you do not file the Form 8832 for tax purposes, the IRS will treat your business as a sole proprietorship if it has a single owner and a partnership if it has two or more members. You have to note that even though the LLC is treated as a sole proprietorship for tax purposes by the IRS, the single member owner of the LLC generally maintains limited personal liability protection from the debts and actions of the LLC, unlike the actual sole proprietorship, where the owner would be equally liable for the debts and actions of the sole proprietorship. There are instructions with the form that explain the classifications. If you disagree with the default election classification, you can still file the Form 8832 to request a change. As I stated previously about the sole proprietorship, when you get into an LLC, it's a different keg of worms with that LLC. It is although you get the benefits of being a sole proprietorship where you don't have to go through as much to set it up, you have that protection. But one of the things that this lesson doesn't necessarily cover is that if you go in and you don't do certain things with paying your taxes, your federal federal taxes, meaning your payroll taxes for your employees and everything like that, you can end up owing trust fund taxes. Trust fund taxes are the portion of your taxes that were withheld from your employees' pay, because when you promise to pay your employees, they fill out a W-4 and they get that and they're supposed to have certain amounts withheld on that from that W-4, meaning federal income tax withheld and half of their social security and Medicare. Well, if you don't pay it, you could be personally liable for it. You don't we The IRS doesn't have to do too much to collect it under a sole proprietorship. Under a LLC sole proprietorship, they have to go through and do a trust fund assessment. The trust fund is where they go in, they do an interview with you, determine who's responsible. As a sole owner, you pretty much tag your it most of the time unless something else went on. and then you end up with that assessment on you. And they when they do the assessment, it's almost just like regular a regular tax debt, where it can where you can end up with, liens filed and things like that. So you have to be wary of that as well, because a lot of people think that, you're not going to be held liable just because you have a business or such. Okay, so we're going to move on swiftly and professionally. We've talked about limited liability companies. Now we're going to go into sharing or gig economy. Okay, gig economy income is taxable. If you earn income as a rideshare driver, rental host, or online seller, your business is a part of the gig economy. The gig economy, also called sharing economy or access economy, is any activity where people earn income providing on-demand work, services, or goods. Often it's through a digital platform like an app or website. And you can look at the irs.gov. We have an entire section on the gig economy. You would look up the Gig Economy Tax Center, where you can find general information about tax issues that arise in the gig economy and how to file your taxes. Now, the next thing we're going to talk about is choosing a paid preparer. All right, now for the this is the last topic for the lesson. When you're choosing a paid preparer, if you do decide to use a paid preparer, remember you are still legally responsible for the information on your own tax return. So that's why you take classes like this and go to and get as much knowledge as you can, because although these preparers are preparing your return, it's still your return, and you're the person that's responsible for paying it. You know, or if there's an error, we're going to come back to you. We're not going to go back to them immediately. They may get a letter because they're on the return, but you're going to get one too. So some of the points you need to be aware of is you want to avoid preparers who claim that they can obtain larger refunds than others. Uh, Typically, they do that. They're trying to charge you for the amount of your refund and things like that. That's not a good sign. You would avoid preparers who base their fees on the amount of your refund, like I said, and you avoid pay preparers who won't sign the tax return or won't give you a copy of your tax return. Those we consider those ghost preparers, which that's on our website too. You can look at that. Never sign a blank tax return, and never sign a completed form without reviewing it and making sure you understand the return. Finally, consider whether the preparer will be available to answer questions about the return for months or even years after the return is filed. The IRS now has a registration and certification process for preparers. To ensure that you are working with an honest and reputable preparer, make sure that the paid preparer has a valid IRS preparer tax identification number, also known as a P10. All preparers, whatever their professional designation, must have a valid P10. You can find more tips on irs.gov. Simply type choosing a preparer in the search box. Now, when you're looking at a paid preparer, you also have the option of there are different types of preparers. Um, the the testing they must undergo is kind of how they designate these preparers. They have certain continuing education requirements, and their practice rights before the IRS will tell you what who they are. We're going to talk about several types of preparers. First, we're going to look at enrolled agents. Okay, so an enrolled agent is a person who has earned the privilege of representing taxpayers before the IRS. Most enrolled agents have passed a three-part comprehensive IRS test covering individual and business tax return representation rules. They must adhere to ethical standards and complete 72 hours of continuing education courses over 3 years. Enrolled agents have unlimited practice rights, which means they are unrestricted as to which taxpayers they can represent, what types of tax matters they can handle, and which IRS offices they can represent clients before. To learn more about enrolled agents, you go to CSEC Treasury Department Circular 230 or visit irs.gov and type enrolled agents in the search box. Some individuals become enrolled agents through experience as a former IRS employee. Instead of passing the three-part test, which they're thinking about changing that, but they don't necessarily have to pass the three-part test now. But in the future, they may have to. These individuals may be limited in their practice rights to only matters that they have expertise in, as you can find more tips on irs.gov simply by choosing a preparer in the search box. Like, you have former revenue officers and revenue agents that are out there that chose to be enrolled agents after they've left the service. I will say that a lot of experience that is gained as an you've got a revenue officer that had worked in collections, maybe someone that you're working with that would represent you before collections, because they pretty much know the rules on that now, um as a former employee. Now the next one we're going to look at is, okay, and you can look at I was also saying you can look at the IRS website for more information about those enrolled agents. And then we have CPAs and attorneys, both certified public accountants and who are known as CPAs and attorneys, have their own professional requirements for continuing education. Both groups have unlimited practice rights before the Internal Revenue Service, so they can represent you in before anything. Then you have annual filing season program participants. Now, this voluntary program recognizes the efforts of return preparers who are generally not attorneys, CPAs, or enrolled agents. It was designed to encourage education and filing season readiness. The IRS issues an annual filing season program record of completion to return preparers who obtain a certain number of continuing education hours in preparation for a specific tax year. Beginning with returns filed after December 31st, 2015, only annual filing season program participants have limited practice rights. This means they may only represent clients whose returns they have prepared and signed, but only before revenue agents, customer service representatives, and similar IRS employees, including the Taxpayer Advocate Service. They cannot represent clients whose returns they did not prepare, and they cannot represent clients regarding appeals or collection issues, even if they did prepare the returns in question. So when you're picking up, when you're picking a representative, you might want to take note of that, because there's other people that are out there that will say they can represent before the IRS, and they can, but only with the returns that they prepared, and only before certain areas. Like, collection does not deal with that at all. Now we also have P10 holders, tax return preparers who have an active P10, prepare a tax identification number, but no professional credentials and do not participate in the annual filing season program, are authorized to prepare tax returns. Beginning January 1st, 2016, that is the only authority they have. They have no authority to represent clients before the IRS except regarding returns they have prepared and filed December 31st, 2015 and prior. So anything after that point, they wouldn't be able to represent you. They can prepare your return, but as far as representing, no. Now, we also have a directory of federal return preparers with credentials and select qualifications. This is to help you determine return preparer credentials and qualifications. The IRS has a public directory containing certain tax professionals. The searchable, sortable database includes the name, city, state, and zip code of attorneys, CPAs, enrolled agents, enrolled retirement plan agents, and enrolled actuaries with valid P10s for the years 2016 and forward, as well as annual filing season program record of completion recipients. You can find that on our website, that directory on our website on irs.gov, and it would help you to be able to choose your return preparer. So you've got a lot of information, and it was a lot of information in a short period of time, but hopefully, um Everything you presented today can be found, well, first of all, everything I've presented today can be found on our website. If it's any topic that you're looking for, go in and just search for it on our website at the top. And for more information, you can go to, well, that's not available on our video portal, isn't available, but we do have a lot of information from those sites that I gave you throughout the lesson. And I'm also giving my slide deck to Sheila and April, I believe. And well, I think I gave it to April to pet to serve you or give you as well. This is my information. I am a stakeholder liaison with with the Internal Revenue Service. I do not have access to account information, but I have access to a lot of general information and information that I can share if I need to, or if you need to locate something or you're trying to find something out. I'm very good at giving you what you need. So if you have need assistance, you have a contact, and that is me,
Cheryl,
Sheila.
thank
And
you.
yes,
It's always good to have a contact.
yes.
About 10 minutes left, and we do have quite a few questions. So if
Okay,
you don't
good.
mind, I'm going to go ahead and read a couple aloud now and see if you can get them answered for us. The first one came in
Okay,
right after you started. The question was, are bank account records sufficient, or will physical separate receipts be required?
They like bank account records, but in order to prove whether a something is for your business, a lot of times they do want you to have the receipt for certain things. Like, say for example, you bought a computer. They want to know that that computer is for your business, so you need to keep the receipt, especially larger things. But also, if you're trying to do expenses for things like meals and things like that, there's certain limitations that they have, and I didn't go over into that. That's in our upcoming upcoming webinar on record keeping, where there's certain things that you need to know about, whether it's too much. Like, you're going out, some people will say a meal, a $50 meal is too much for a luncheon, but it depends on what you're getting, where, what the type of business you're doing at that luncheon is for. Certain businesses, if you're doing bigger business and the money is a larger amount, you may a large meal may be warranted for that particular item. It all depends on what you're doing, what type of what type of expense it is, and what type of income you're dealing with. You know, in some cases, it might be a $10 meal, might be a good meal for whatever you're doing as far as what type of expense you have, but you definitely will want to keep individual receipts for a business.
Okay. Next question. If my business wages are my only wages, sole proprietor LLC, and I file
Mhm.
my personal tax return reporting those wages, then do I need to file a separate business tax return, or is my personal tax return sufficient?
Okay, and this is with someone with the LLC, right?
Yeah,
Okay,
correct. Yeah.
with an LLC and you're a single member LLC, they they require you to, with the single member LLC, you're required to file the information on a they require you to file it on your personal side if you're considered a single member. If you make the designation to be a single member LLC, or if they designate you to be a single member LLC, you would be filing the Schedule C, the information on your Schedule C, and you don't have to have the forms that transmit the income back over. A lot of times, if you've decided to go as a corporation, you still have to have a separate tax return just for that business, because the business is its own entity when you go with a corporation. But once you have a single member LLC like that, you don't have to have two returns. It's just one,
Okay.
because all of the
Let's-
income is on that one.
okay. Let's see, another question. My business is an LLC. I didn't know I had to choose SC or partnership. What does that mean for taxes?
Okay, when you went in to set up your business, they typically will give you, you're automatically designated based on if you didn't do an 8832. So it kind of depends on what happened in the beginning of what you've got going on. If you didn't designate anything and it's only you, they'll automatically put you in the category of being a sole proprietor, a single member LLC, um, sole proprietor. And basically you're filing the regular return. Now, if you went in and did that Schedule C and it's like more than one person, then you didn't decide, make a designation for it, then it's going to be the partnership where you're doing it just like you would a partnership where you got the K1s for each person and the 1065 K1s and things like that. So it all depends on what you did, and if you didn't do anything, then they're going to designate it for you anyway.
Okay, so we got 5 minutes left. Still have quite a few questions, so let's see what we can get through. When are the deadlines for filing? I have a new corporation with a fiscal year end of 6/30.
Okay, wait a minute. So they're saying they had a fiscal year of 6/30, and what happened?
And they're asking when's the deadline for filing?
Okay, so it's 3 months from the date of the it's 3 months from the date of the end of year. So it would be September. It would be September the 30. What is it? September 30 days
30th.
in September. Yeah, the
Yeah.
30th. The basic stuff is where I get thrown in.
Okay, so 3 months after the year
Yeah.
is okay. Let's see what else we have here. So for LLC sole proprietary, do I fill 2 separate tax returns, one for the business and one for me?
No. The sole proprietor, you're basically just everything is going to be on your Schedule C. If you have employees and you have a tax ID number, even with having a tax ID number, you still everything can still be on that Schedule C, because the Schedule C actually has a thing where you can put a tax ID number on there. When you get into the Schedule C, and or rather when you get into the having the employees, then of course you're filing the 941s, you're filing the 940s. That can get complicated as well, but you're still in the on your Schedule C, showing all of your income and things like that.
Okay. Is there a way to determine an existing LLC's entity classification election?
You can contact the Internal Revenue Service, or you can go, if you have an online account, you can go on there. It will tell you whether you are they have it on there, whether it's single member, whether it's now the disregarded entity part of that. It I know when I'm just kind of going back in my mind on the system that we use. They have everything as far as your filing requirements on there. So it should be on your online account. If you whether you have a business online account, or you have whether you have your business online account. And the thing is that they have it set up where the business online account for a tax ID number would have all that information on there as well. So you don't necessarily have to call in unless you just don't have an online account. But one of the things we try to tell you is you probably would want an online account, because it actually will help you be able to go in and look at things and keep track of your information, and make it so that part of your record keeping can be going in there and making sure that certain things are done the way that you need them done. So I would say that would be the best way to check it if you don't have that already included in your information. So
Okay. So we're down to 2 minutes. Let's see. Can you change the name on your EIN without creating a new one?
Okay.
I'm going to stop for
that
one
one.
second and say, we're going to send out the email. So, an email that it's going to have contact for Cheryl and for the SBDC. So, of course, any questions that aren't answered, please reach out to us so we can get those questions answered.
And
Okay.
if you want to copy those and send them to me, I can go in and kind of look at them, and it depends, but you've got my information. So
Yeah.
if it's something,
Okay.
yeah, you can call me.
Okay.
But you also, if it's something like basic tax information, a lot of times we might say you might want to check on our website first,
Okay.
just to see. And
Okay.
okay, so
And so
let's
I
get
did
back to the
interrupt you. Can
question.
you change the name on your EIN without creating a new one?
Okay. As far as changing the name, I know that you can change the address. Um, but I know that there is a way. I'm trying to think of the way that they change the name. It is throwing me right now because I'm thinking that's the last one is going to throw me off. Um, as far as changing the name, they and it's for a sole proprietorship. That with the sole proprietorship is more of a doing business as, but with a regular LLC, I think with the 8822, it only changes the address. To do an entity change, that takes a little bit more work.
Okay.
Um, and I'm trying to think, do they do it on the tax return itself? Um, can you request like a written request to do a name change for the business? I know you have to go through the state also if you're going to do a name change as well. So there might be more of a state thing first, So but
Well,
yeah,
we are out of time.
we out of
There are a
time.
lot of
I'm
great
so
questions.
sorry.
I'm gonna please reach out. I put Cheryl's email up. You have the help email. Again, we're gonna send out an email to you all that will have all this information in it. So please use all your references. I know April and Jenny here that have joined us. They'll be able to help as well, or your local SBDC advisors. So wow, that's a lot of good information. I want to thank you, Cheryl, for presenting all of this to us. And again,
Thank you
I'd also
so
like to
much.
thank April and Jenny with our Blue Ridge Crossroads SBDC for collaborating on this IRS webinar series. Of course, thank you all for attending today. And as a reminder, you're going to receive that email with a link to the recording and to these slides. If you would like to sign up for upcoming webinars or access recorded webinars, please visit virginiasbdc.org/training. These resources are designed to be used in collaboration with your local SBDC advisors. You can sign up for a free and confidential session by emailing help@virginiasbdc.org or via our website. And we hope to see you at our next session. Take care, everyone.
Thank you.